Good morning. This is Dr. M. Vijay Kumar, Assistant Professor of Commerce, MVS Government Arts and Science College Autonomous, Mahbub Nagar, Telangana State. In the series of video lectures of commerce, accounting, and business management, today we are discussing about working capital management. Working capital management and its essence and importance and concepts. In the present video lecture, we are going to know the detailed information related to the working capital management. After completion of this video lesson, the learning outcomes of this lesson, you should be able to understand the concepts of working capital, the meaning of working capital, definition of working capital, and basic essential items of the working capital also. And also you will able to understand the critical aspects of working capital issues, and you can get familiarized with financing current assets, short term, long term, and a mix of current assets. And it is also to learn the combining the liability structure and current asset decisions related to working capital management. Then now we will have the glance related to the working capital management. Working capital management, the concept of working capital management, its meaning that working capital may be regarded as lifeblood of a business. It is effective provision, can do much to ensure the success of a business, while its inefficient management can lead not only to lost profits but also to the ultimate downfall of what otherwise might be considered as a promising concern. Similarly, how the blood of human beings circulate in the body, the working capital also must circulate within the business operations. That's why it's a circular finance, circulating finance of a business concern. A study of working capital is of major importance to internal and external analysis because of its close relationship with the current day-to-day operations of a business. Simply we can say working capital means the capital which is required to run a business smoothly in day-to-day operations. Every business needs funds for two purposes: for its establishment and carry out its day-to-day operations. Long-term funds are required to create production facilities through purchase of fixed assets such as plant and machinery, land, building, furniture, etc. Investment in these assets represents that part of the firm's capital which is blocked on the permanent or fixed basis, which is called as fixed capital. It means that we can categorize the capital of a firm into two ways: one as a fixed capital, another is working capital. Fixed capital and fluctuating capital. Fixed capital is the capital, the investment made on the fixed assets of a business concern, which yield the benefit in the long term, long run, is known as fixed capital. Working capital, the capital or the investment made on the current assets of a business concern, through which the yield will be within a short period of time, that may be maximum to the extent of 1 year. Funds also needed for short-term purposes for purchase of raw material, payment of wages, and other day-to-day expenses. Such all will be considered under the working capital. These funds are known as working capital. Working capital is the capital required to run the business smoothly by procuring its raw material, payment of wages, and other expenses for regular maintenance of the business concern. The working capital is the difference between the inflow and outflow of the funds, we can say. In other words, it is the net cash inflow. It is also defined as the excess of current assets over current liabilities and provisions. Net current assets or net working capital. The capital required for a business can be classified under two main categories. One is fixed and working capital, as we discussed in the previous slide. The working capital. Working capital refers to that part of the firm's capital which is required for financing short term or current assets such as cash, marketable securities, debtors, and inventories. Funds thus invested in the current assets keep in revolving the fast and are constantly converted into cash, and this cash flow out again in exchange of other current assets. Working capital is also known as revolving or circulating capital or short term capital of a business concern. Generally, working capital will be generated within the business through its operations in a particular year. The concept of working capital. There are two possible interpretations of working capital concept. One is balance sheet concept, another is operating cycle concept. If we go to the balance sheet concept, there are two interpretations of working capital under this balance sheet concept. Working capital is the excess of current assets over current liabilities. Or we can say working capital, the gross or the total current assets. Total current assets value is known as the gross working capital. Or if you take the total current assets minus current liabilities and provisions, you will get net working capital. The excess of current assets over current liabilities are called the net working capital or net current assets. The working capital is really what a part of long-term finance is locked in and used for supporting the current activities. The balance sheet definition of the working capital is meaningful only as an indication of the firm's current solvency in repaying its creditors. Means finally we can say that the short-term solvency capability, short-term financial stability of a business concern depends on the working capital. The repaying capabilities of the business concern depends on the working capital. It means repaid to the creditors who supplied the raw material, the wages, who provided the services. When firms speak of shortage of working capital, they in fact possibly imply the scarcity of cash resources. In funds flow analysis, an increase in working capital and conventionally defined represents employment or application of funds. Operational cycle concept. Another concept of the working capital is operational cycle concept. A company's operating cycle typically consists of three primary activities. One is purchasing resources, another is producing the product and distributing the product. This is known as the stages of the operating cycle or the activities involved in the operating cycle. Those are purchasing resources, producing the product, distribution of the product. It's a circular form, that's why it is called as operating cycle. These activities create funds flow that are both unsynchronized and uncertain. Unsynchronized and uncertain. Unsynchronized because cash disbursements, for example, payments for resources purchases, usually take place before cash receipts. For example, collection of the receivables. They are uncertain because future sales and costs which generate the respective receipts and disbursements cannot be forecasted with the complete accuracy. The firm has to maintain the cash balance to pay the bills as they come due in the short run. In addition, the company must invest in inventories to fill customer orders promptly. And finally, the company invests in accounts receivables to extend the credit to customers. Operating cycle is equal to the length of the inventory and receivables conversion period. This is nothing but operating cycle. It represents that cash to cash. Generally, cash to purchase will be converted into the raw material into converted into the work in progress will be converted into the finished goods will be converted into the debtors will be converted into the cash. The operating cycle is represented by the term, the period implied are applicable to the convert cash to cash. Means once again, cash from cash to purchases. Purchase is nothing but the raw material to the work in progress. Work in progress to the finished goods. Finished goods will be converted into the debtors. Debtors will be again converted into the cash. It is a cycle taken to complete the one process is called a cycle. That cycle represents the time to complete the process. Then types of working capital. If we discuss the types of working capital can be categorized into different ways based on the concept and based on the time. On the basis of concept wise, working capital can be categorized into two ways. One is gross working capital. It's for understanding clearly gross working capital and net working capital. Gross working capital, already we discussed about this in the previous slides. Gross working capital is equal to the total current assets value. Net working capital is equal to the difference between the total current assets minus total current liabilities and provisions. That's why what we can say, gross working capital is equal to the total current assets. Net working capital is equal to the net current assets. The working capital classification based on the time taken to make investment. One is the permanent or fixed working capital. Another is temporary or variable working capital. Permanent working capital and temporary working capital. Permanent working capital is also considered as a fixed working capital. Temporary working capital will be treated as variable working capital. The temporary working capital that depends on the seasonal and special cases. That's why temporary working capital can be categorized into two ways. One as seasonal working capital, another as special working capital. If you move to the permanent working capital will be two ways. That will be the regular working capital and reserve working capital. Regular working capital, reserve working capital. In depth, if we make the classification of the working capital, we can categorize into different ways. One as gross working capital, that is equal to the total current assets. Another is net working capital, that is equal to total current assets minus total current liabilities and provisions. If you move to the permanent working capital, there will be the regular working capital and reserve working capital. In the temporary working capital, it will be treated as seasonal working capital and special working capital. Operating cycle of a typical company. Operating cycle of a typical company. As we discussed just now, operating cycle, it will have some stages. One is purchase of resources. Another is payment to the resources purchased. Another is selling of product on credit and converting into the cash. Here a table is shown that the cycle period from purchase of resources to conversion into the cash. First, purchase resources, pay for resources, that is purchases, and sell the product on credit basis and convert the credit sales into cash. Or inventory conversion period, receivables conversion period, payable deferral period, cash conversion cycle, overall operating cycle. Inventory conversion period. We will apply a formula to find out the inventory conversion period. That is average inventory by total cost of sales into 365. Entire year is taken as 365 days. Now the conversion period is in days, in number of days. Average inventory by the cost of sales into 365. We will get the inventory conversion period. And if we need the receivable conversion period, we can apply another formula, that is accounts receivables by annual credit sales into 365. Receivables conversion period is equal to account receivables by annual credit sales into 365. Payables deferral period means we are due to the wages, due to the suppliers In such cases, to find out the conversion period, payable deferral period, that is accounts payable plus salaries etc. divided by cost of sales plus selling and general and administrative expenses into 365. We will get payable deferral period. These all periods together, the cash conversion cycle is equal to operating cycle minus payable deferral period. Cash conversion cycle is equal to operating cycle minus payable deferral period. Importance of working capital. If we think risk and uncertainty involved in managing the cash flows. Yes, we are sure. Uncertainty in demand and supply of the goods. Yes, it is sure. Escalation in cost, both operating and financial costs. That's why we have to think about the working capital management. Strategies to overcome the problem, manage the working capital investment or financing such assets in a proper manner by understanding the requirements. Holding additional cash balances beyond expected needs is required. Holding a reserve of short-term marketable securities is also necessary. Arrange for availability of additional short-term borrowing capacity. One of the way to address all the problems related to that fixed setup cost. One or combination of above strategies will be target the problem. Working capital cycle is the lifeblood of the firm. Why? Because it is a circulating finance of the firm. Resources flow of a manufacturing firm you can understand just by watching this slide. Observe the slide carefully. The slide, it is in a rectangular form. It is given. Production process generates inventory. Via sales generate accounts receivables. Production process used in accrued direct labor and material. Accounts receivables collection process will be taken place. Then that will be converted into the cash and marketable securities. By using cash and marketable securities, you can purchase material. By applying the direct labor and material, you can make production. That production will be converted into inventory. That inventory will be converted into account receivables by sales. Sales generates account receivables. Purchase generates payables. The same cash or marketable securities used to purchase fixed assets. Same cash and marketable securities used to accrued fixed operating expenses. The suppliers will generate external financing, and the same cash and marketable securities used as return on capital, that is called as return on the investments made by the suppliers. This is the resource flow of a manufacturing firm. Working capital management in that the size and nature of investment in current assets is a function of different factors such as type of products manufactured, the length of operating cycle, sales level, inventory policies, unexpected demand and unanticipated delay in obtaining the new inventories, credit policies and current assets. If you move once again the current capital, working capital concepts. The one, net working capital, you know that. Current assets minus current liabilities, or current assets minus current liabilities and provisions. If you think about the gross working capital, the firm's investment in total current assets is called as gross working capital. Working capital management means the administration of firm's current assets and financing needed to support the current assets is working capital management. Now we will move to the significance of working capital management. Working capital management. In a typical manufacturing firm, current assets exceed one half of the total assets. Yes, Sometimes excessive levels can result in a substandard return on investments. Current liabilities are principal source of external financing for small firms. Requires continuous day-to-day managerial supervision. Working capital management affects the company's risk, return, and share price also. Working capital issues. Optimum amount of level of current assets should be there. If there are three types of policies of investment A, B, C, optimum level of current assets. Assumption 50,000 maximum units of production. Continuous production. Three different policies for current assets levels are possible. Impact on the liquidity. Greater current assets levels generates more liquidity. All other factors held constant. You can observe in the slide that policy A, high level liquidity, policy B, average liquidity, policy C, low level liquidity. Means conclusion will be the greater current assets levels generates more liquidity when all other factors are constant. If you think on the impact on expected profitability, policy A, policy B, policy C. The return on investment can be calculated by applying the formula net profit by the total assets. Let current assets is equal to cash plus receivables plus inventory. Return on investment is equal to net profit by current plus fixed assets. Yes. In the policy A, policy B, policy C. Policy A, low profitability, B, average profitability, C, high profitability. As current assets levels decline, the total assets will decline and return on investment will rise. Means current assets decline, total assets will decline and the return on investment will rise. Impact of the risk. Decreasing cash reduces the firm's ability to meet its financial obligations. Then we can say this as more risk involved when the decrease in the cash. Stricter credit policies reduce the receivables and possibly lose sales and customers. More risk. Lower inventory levels increase stockouts and lost sales. More risks. Means lower level of current assets individually impacts on the risk. If policy point of view, if we discuss about the risk impact, policy A low, policy B average, policy C high. Risk increases as the level of current assets are reduced. This we have to understand. The summary of optimal amount of current assets. In all three cases, the impact of the current assets. Policy A, liquidity high, profitability low, risk low. Policy B, liquidity average, profitability average, risk average. Policy C, liquidity low, profitability high, risk high. Profitability varies inversely with the liquidity. Profitability moves together with risk. Risk and return go hand in hand. That is the clear. As we discussed in the previous slides, the classification of working capital, the components, cash, marketable securities, receivables and inventories. Time point of view, permanent capital, working capital, temporary working capital. This slide showing the clearly that the permanent working capital, the amount of current assets required to meet firm's long-term minimum needs. Long-term minimum needs, that is permanent working capital. Temporary working capital, the amount of current assets that varies with seasonal requirements. The graph it is showing the seasonal requirements. The first line, below line, showing that the permanent current assets, temporary current assets is fluctuating due to the seasonal changes. Financing current assets, that is short term and long term mix. Spontaneous financing Spontaneous financing, trade credit, and other payables and accruals that arise spontaneously in the firm's day to day operations. Based on the policies regarding payment for purchase, labor, taxes, and other expenses, we are concerned with the managing non spontaneous financing of assets. Hedging and maturity, this we will discuss in the next video. Thank you. Thank you for your listening.